All right, we're going to get started today by looking at the S&P 500 chart. You can see that the S&P is above all moving averages, and we do have positive momentum. Um, uh, we're we're overbought right now in the stochastics. You can see that we've been overbought for like 3 months. So we had an exponential return in a lot of the technology AI related stocks until this point for the last couple months. Let's look at our earnings, and let's look at our calendar. You can see that we're right in the middle of May. We had what's known as options expiration this past Friday on the 15th. Okay, that is whenever options expire. There's a lot of volatility. We had the market go down uh, with a lot of the big volatile stocks that we're watching. And right now is a very interesting time of the year. Every quarter, all of the big institutional money management companies, such as hedge funds, mutual funds, have to report their top holdings. And this is pretty exciting for me. It's always great to find out what the best minds in the world are buying and selling, and you get to see that every quarter. So this this weekend, the 16th and 17th, I've been going over changes in the portfolio of some of the best investors, including Warren Buffett. So we're going to go over that today, and we're going to see some of the changes and what's being held by some of the top money managers. The other thing we look forward to here is Memorial Day. That's a federal holiday. It's a lot of times people in the stock market feel good around the holidays, so you might have some positive activity around that time. Now, remember, the summer isn't that seasonality wise. Let's look at the seasonality for the stock market. You can see that June, August, September are some of the worst months of the year. So we are halfway almost done with May. And then we get into a couple months where we have subpar returns. So keep that in mind right now because um, if you're going to establish new positions, it'd probably be a better idea to establish new positions whenever this market's down. So what are some excuses we have right now? We're in May. Well, we have a new Fed chair. So um, that Fed chair is going to be tested. And um, we have a lot of inflation. We have an inflation rate of 3.8, which is pretty high compared to what it's been. So, and we have a high price of oil and all of those, and we have high interest rates on the 10-year. So a combination of those are not good for the stock market. So that could naturally, those in itself could make the stock market not do so well. Let's see what happens. Okay, so what else do we have to look forward to? Um, okay, July 4th, we have this is one of the most celebrated times of the year in America. We have fireworks, we have parties, and good feelings, and that's that leads to a better stock market returns also. So we expect there to be very good stock market returns right around July 4th timeframe. And okay, so we have August and September marked as red, along with February as not so great months of the year. Okay, let's look at some of the earnings that came out in the past week. Actually, the biggest earnings report was Cisco. They came out with better than expected earnings and projections. So that made that stock go up around 13, 14% that day. So every other stock that reported wasn't as consequential. Okay, so let's look at the week coming up. Okay, we've been all waiting for NVIDIA earnings. They are coming up this Wednesday. And a lot of times um, what's been happening recently with NVIDIA, they could report a really good earnings report. But if you have buying into the earnings report, it may just go down because you buy in the rumors, sell in the news. So let's see if that happens. They have a lot of tailwinds going for them. They have a lot of their investments have gone up a lot recently. For instance, they invested in Intel, and it has more than tripled this year. And we have Walmart. They're going to be reporting. Walmart is a good um, barometer of economic activity in America because it affects almost every household in America, and it basically their report will tell us if the consumer is still spending or not. And let us see what look at our numbers next. S&P, it's been very volatile this week, but believe it or not, it's unchanged. Um, we 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 have we're losing some momentum. Last week we had a 43% stocks above the 50-day moving average. Last week it was 51, now it's 43. And last week we had 53% above the 200-day moving average. Now we have 50. So we're losing momentum. Um, and part of that reason is the oil price of oil has gone up, and we had the 10-year go up a lot also. So the 10-year, okay, so that's really big. Wait, hold on for a second. Let's look at the 10-year. You can see that it's gone up. It's gone up a lot. Something like 4% this past week. So usually the stock market goes down whenever the um, the interest rate of the 10-year goes up. So a lot of this has to do with the price of oil also. So let's look at our formula. The formula for in general, the price of oil increases, inflation increases, the chance of rate cuts go down, and the chance of rate hikes go up. So the stock market does not like rate hikes, and it will go down if there are rate hikes. And the chances of a recession also go up as inflation goes up and as the price of oil goes up. So that's kind of the scenario we have this week. So let's see what happens. Um, Basically, when you're investing in stocks, you have to realize that you have these variables such as the price of oil and interest rates that are variables that totally affect what people are willing to pay for stocks. So that's why we keep track of a fair value of each of the stocks that we're following so that whenever the stock market does something based on maybe the interest rates or some other thing, one of these variables such as oil, we know what a stock is worth, and that is good to know. Let's look at the S&P 500 chart. You can see that we have an uptrend. We had this little glitch here, and we recovered totally from that. We are at the top end of the range for our S&P 500. So, and we're overbought. You can see we're overbought here. So it's not a good idea to buy stocks in general right now because we're overbought and we're at the top end of our range. So the S&P short range oscillator, however, it is near neutral. So we neither have a um, overbought or oversold according to the S&P short range oscillator. So we're neutral for that. Um, all right, so let's look at the 10-year again. You can see that the S&P 500 has been rallying recently, even though in general the yield to the 10-year has been going up. Usually they don't go up together because the basic formula is the the more it costs for corporations to borrow money, the less they're going to grow because they're less profitable. And as the 10-year yield goes down, that makes it easier to borrow money and easier for companies to grow. So right now, we shouldn't ever see this one-to-one correlation. One of these is not right. Um, Usually the bond market is smarter than the stock market. So if the bond market yields for the 10-year are going up, the chances are the S&P 500 is going to go down. So because all right, so let's look at some of our variables affecting the stock market. We have the price of oil up 11% since last week. That is pretty major. And high oil is inflationary. We had some inflation readings this week, and they're basically telling us that inflation has gone up. Last week it was 3.30, now it's 3.8. That is one of the major reasons why the stock market went down this past Friday. Um, I think it's a combination of tariff pressures and price of oil leading to inflation. Let's look at the dollar index. The DXY is up 1.5%. So as the dollar index goes down, commodities go up, such as gold. As the dollar index, so we didn't have that happen this week. We had the gold ETF go down 3.87%. I'm not sure why that's happening. Um, we do have a lot of central banks buying gold around the world, and that right now it's like a speculative asset because gold doesn't really produce any cash flow, and so Warren Buffett doesn't like to invest in gold because he likes cash flow, he likes earnings power. So let me see what else do we have to say here. Okay, the US dollar index is kind of sideways. That's good for companies in general because they have consistent earnings without having to worry about overseas sales affecting their earnings. The fear and greed index, we have greed, and it was greed 67 last week. We're just a little bit less greedy this week, but our translation is caution, take some profits off the table or don't buy. You know, by our charts, we already said that we are overbought and at the top of our range in the S&P. So if we look at our S&P, you can see we're here. We're, we're kind of overbought in our stochastics. That all kind of leads us to it's not a good idea to start buying things now. Okay. And this greed and fear, it's very important. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. We're going to go over some of Warren Buffett's recent moves in the stock market a little bit later. All right, so you can see that the average investor is bullish. So we got to take the opposite side and take some profits off the table or don't buy now. Okay. And the VIX is really low. We don't have a whole lot of people expecting major negative outcomes. We don't have a whole lot of put buying. People aren't afraid right now. So that is really good for the stock market continuing to go up, having a low VIX. In our emotional graph, we're in greed right now, and we're approaching this new paradigm kind of euphoria in the stock market. And we're approaching the also the summer months, which are traditionally not so great. So I expect between now and the end of August, September, to have some return to the normal, some fear. Whenever the stocks go down, people are like, oh no, we'll just buy in the dip. And then we'll have some capitulation. So right now we're in the greed. So enjoy the stock market going up. But this is the time Warren Buffett wants to hoard cash and not buy things. And Warren Buffett would much rather buy when people are selling. Okay, let's look at some of the sectors that have gone up and down this year. We can see that consumer discretionary, healthcare, and financials are the worst performing sectors. They didn't do that great last year either, but we can see some of the sectors that did bad last year, the energy, consumer staples, and real estate are doing good this year. And the best performing sector, let's look at the best performing sector. It's energy by far. It's 32%. Then we have IT, consumer staples, communication sector, industrials, and materials. The worst sector is financials. Believe it or not, those are the most undervalued compared to history. They trade at the least, the PE valuations are the lowest compared to history. And energy also is kind of a deal also. Healthcare, they have had negative earnings revisions. So there's a reason why the healthcare is out of favor right now. But the IT, a lot of the S&P 500 have had positive earnings revisions, and they're growing their earnings around 15% or more this year. Let's look at the stocks going up and down. Well, first of all, let's look at, okay, we know by the 10-year that the yields are going up. So let's look at our translation for the yields going up. The yields of the 10-year going up, that often signals expectations of stronger economic growth with higher inflation. A rising 10-year treasury generally acts as a headwind for the stock market as it increases the cost of capital and offers a higher risk-free return. So if we look at the S&P, okay, you can see that this is a really big move for the 10-year going up. So we are definitely going up. That's positive for banks, value stocks, energy materials. It's negative for high tech and high growth stocks, high yielding stocks, and home builders. Let's see if that is in our top stocks going up and down. The energy stocks, that's at the mercy of the price of oil. Price of oil has gone up 10% since last week, so that's why that's going up. Financials are doing well. Increasing interest rates are good for financials. Consumer staples, they pay a dividend, so interest interest rates going up on a 10-year are not good for dividend paying stocks. Let's look at the stocks going down the most. Gold, that's because the price of gold has gone down. And semiconductors, home builders, that makes sense. You have a higher interest rate on a 10-year, the home builders won't sell as many homes because it's less affordable with higher interest rates. Same with home construction. Biotechs are very dependent on borrowing money. As the price of the 10-year goes up, it costs them more to borrow money and they're less profitable. That's why they're down today. Telecom, they're high dividend paying stocks. So you'd expect higher dividend paying stocks to be less in demand when there's a guaranteed 10-year going up. So that was a good exercise. Let's look at some of the stocks going up and down. Okay, so we see oil dominating the top performers today. Oil has been up 10% in the past week, so half of the stocks in the top market movers are oil. We have some of the stocks that have been sold off a lot. The software stocks are like, so I don't know if it's a dead cat bounce or not. ServiceNow, FactSet, these are stocks that are considered software companies, and software and software as a service companies have been pummeled, and they've gone down like 20 to 50% this year because of the fear of AI displacing their businesses. Adobe is another company that's a software company. Intuit, also a software company. So they're catching a bid now. So the stocks that have rallied this year are the ones going down the most today. These are the AI darlings, the Corning, Coinbase, Micron, Intel, Supermicro. Okay, these are all AI related stocks. All right, that was a good excursion. Let's look the current stock market narrative according to Google AI. Um, right now, our themes are AI dominance and earnings. All related companies are propping up the S&P 500's earning growth. The first quarter earnings have significantly exceeded expectations with a 26% growth pace in the S&P 500. Market concentration, the rally is considered narrow, with only half of the stocks trading above their 50-day moving average. See, that's what we were talking about earlier, suggesting that further upside may become more selective, meaning Google AI thinks we're topping out and it's going to be harder to go higher from here. Geopolitical inflation risks. The conflict in Iran and rising oil prices have introduced volatility. Although the market has largely shrugged this off um, to reach new highs, however, some analysts view the recent sharp multi-week rally as needing a period of consolidation. So Google AI thinks we are in a spot right now where we're done going up and we're starting to consolidate sideways or go down. Bond market warning. While stocks rally, the bond market is flashing a warning sign as Treasury yields rise alongside oil, indicating a potential pressure from sticky inflation. We've kind of said that until now. Um, so this is the most important thing in the stock market. People are willing to pay less for stocks in general when Treasury yields rise and oil rises and inflation rises. So that's going to be the important variables going forward. Consumer sentiment, there is a concern whether the consumer will continue to support the economy. We're going to see the Walmart earnings this next Thursday. That'll tell us a little bit more about the consumer sentiment. All right. I thought these charts are pretty interesting. One is, look at this, XLU, the utilities ETF. It's totally oversold right now. It pays a dividend. So this sector pays a dividend. So as the interest rates go up, the sectors with a yield aren't as attractive. And this is one of those, but you can see that it's at the bottom end of its range. It's oversold. So if there's any volatility in the stock market, people will gravitate towards a conservative sector such as XLU. So if we have a summer which is sideways to negative, this could be a beneficial sector. Let's look at waste management. You can see that waste management is it's kind of oversold right now in the stochastics. and it's towards the bottom end of its trading range. So I like to pick out stocks that are this pays a dividend. It has a duopoly with Republic Services. Um, so let's look at another one. Okay, this is NVIDIA. I mentioned this a while ago. We have a sideways pattern for over a year, maybe a year and a half, and we're starting to break out of it right now. But if we look at our a new different pattern that's happening, the black pattern, we have a different channel happening, but you can see that we're at the top end of that channel, and we are approaching earnings. So even if they have the best earnings report of the world, um, there's been selling on the news. So we could very much see NVIDIA go back down to the bottom end of this range. Okay, so let's look at our stock screen for this week. Okay, we see some interesting stocks. We've already gone through GE Vernova last couple of weeks. We've already gone through Micron. Um, so let's look at Eli Lilly. Eli Lilly is a little bit rich right now. According to Yahoo Fidelity, it's about 30% overvalued, but the return on equity is amazing. It's 101. Um, and the return ROI is three times what we're looking for. I thought it'd be interesting to go over that right now. The healthcare sector is totally out of favor right now. So um, this is a example of one of the stocks I have in my portfolio that I hold for a long term. Um, Eli Lilly is growing at 24%. You can see its growth. This is the earnings estimates. They're growing at 24%, and the PE ratio, forward PE is 26. So if you divide 26 by 24, you'll get the PEG ratio, which is 1.08. So it's around 10% overvalued right now. Um, the theme for Eli Lilly is they have a dominant weight loss drug, and um, they also have a pill that they just came out with that was approved. So that's going to help their earnings going forward. And they have a lot of drugs in the pipeline also. They have a Alzheimer's drug. I don't, and For me, this stock is a good way to diversify. I have a lot of tech stocks in my portfolio. This is a good way to diversify into healthcare. And it's good to buy it when the PEG ratio is less than one. Right now, it's 10% overvalued. You can see the profitability is three times what we're looking for. Return on equity is 10 times what we're looking for. And they have around 38 billion in debt out of 800 billion, which isn't that much. So, and they're profitable. They have a levered key free cash flow of 9 billion. And their pattern is they buy a lot of companies and that have prospective drugs, and that's what they do with their free cash flow. So I think that's a good stock to look at. According to Morningstar, their fair value is they're around 10% overvalued, just like our estimate. So they think their fair value is hold on. They think their fair value is 900, which is 10% below where it's at right now. Um, CFRA says they're a buy with a price target of 20% more than it's at now. They say we have a buy rating as we see Lilly benefiting from the GLP-1 boom and aging population, longevity trends in the next years. Multiple catalysts include the GLP-1 oral pill, Foundayo ramping in the US internationally. It actually costs less for them to make pills than it does for injectables, and it's easier for them to make. So they have that on their side. And internationally, the Alzheimer's disease drug expanding in key markets and solid performances from all these other drugs. So The U.S. government is agreeing to expanding obesity medicine access, and so they're basically making a deal with the United States government where they sell a lot of their drug, but for less cost. So it seems like it's working, but let's wait a little bit. It's 10% overvalued now. I like to buy it when it's less than one peg ratio. CFRA says they're just about, they're overvalued by 6%, which basically it's right around it. It's around 6% overvalued. So I like their earnings in the past couple. Look at this. They have their earnings coming up in a straight line. You can see that's really positive. The earnings have doubled from 2024 to 25. And okay, so I mentioned earlier on when I started this talk, this is the time of the year, every quarter, the companies come out with their updated holdings in their portfolios. One of the most followed portfolios is Berkshire Hathaway. And they made some major changes recently. I thought it'd be interesting to go over some of what they've done. Let's look at the biggest changes. They got rid of all their Amazon. They reduced by 35% Chevron. They more than tripled their Google stake, which is pretty major. And they bought a new position in Delta Airlines. And they bought a position of the other symbol of Google, GOOG. So I asked Google AI about these earnings, these changes that the Berkshire made on their portfolio. Berkshire, let's read this because it's very important. Berkshire Hathaway has significantly increased its investment in Alphabet during Q1, tripling its stake to roughly 16 to 23 billion. Under new leadership, this move signals a shift towards AI and high growth technology, treating Alphabet as a defensive yet growth oriented asset. When Warren Buffett buys things and Berkshire Hathaway buys things, they buy things to hold forever. Their ultimate time to sell is never. So let's look at some of the key details on this Alphabet stake. It's a massive investment. They tripled its shares and it's now in a top five portfolio position. Strategic rationale, the investment reflects confidence in their leadership for AI, strong free cash flow, and fast-growing cloud revenue. And these purchases were made under the new CEO, indicating a willingness to dive into tech. While doubling down on Alphabet, Berkshire's Q1 strategy involved cutting positions in 16 other stocks, including dumping Amazon. All right, so I'm going to go over Delta Airlines, one of their new positions, and we'll breeze over Google because we go over Google a lot. But I thought it'd be interesting to update that. Okay, let's look at Google again. Google's in, this is very similar to the S&P 500. You can see they're at the top end of their trading range and they're super overbought. So it's not a good idea to buy Google right now. You want to buy it when it's down at the bottom end of this range. Okay, let's look at Google's growing at around 16% from this year to next year, and then 15% the next year after that. So their PE is 28 right now, so it's a little bit pricey. The PEG ratio is 1.75 if you divide 28 by 16. So, but it's a stock that'll continue to grow 16% for the foreseeable future. The profit margins are triple what we're looking for. Um, return on equity is triple what we're looking for, and they have more cash than they have debt. They have 30 billion in cash right now. And they're actually aggressively making investments in other companies such as SpaceX and some of the AI companies. All right, so let's look at what CFRA and Morningstar says. Morningstar says they're 19% undervalued. So they say they've increased their fair value up a lot. and they think their biggest part of their business is their AI cloud business. Um, and look at CFRA, they say it's a buy, and with a target of 410, they say it's overvalued by 5%. So it's trading right around their fair value. I like their earnings. Look at this going up in a straight line. This is one of the best looking earnings charts that I've seen, statistics. It basically grows 15% a year, at least for the past 10 years. And it's projected to grow another 15% next year. So Warren Buffett would buy something like this because it's consistent. It has a good past history of earnings, and they have a monopoly in what they do. And the government tried to take them to court for being a monopoly, and they got off with a slap on the hand. So they're going to continue to be a monopoly. Um, okay, so let's look at Delta Airlines. This is an example of a stock that Warren Buffett goes in and out of airlines every once in a while. This is one of the worst industries. I mean, airlines have traditionally traded at PE of 6 because they don't grow a whole lot. Um, let's look at what their growth rates are for last year. It was 25%, 16%, and then 10% for 27 to 28. So let's say they're growing at 16%, and the PE ratio is 13, which is pretty low. Um, so that makes their PEG ratio about 0.75. So they're a little bit undervalued. According to Yahoo Finance, their PEG ratio is 39. That is pretty wild. The return on their profit margin are like half of what Warren Buffett would look for. I don't understand why he would buy this one really. Return on equity is really good. That's double what we're looking for. Um, they have 21 billion in debt out of 48 billion. Half of their market cap is in debt. Well, they have 5 billion in cash. So they have about 16 billion in debt out of 48. So that's substantial. So they're paying down their debt. Um, Usually Warren Buffett likes to have stocks that don't have a lot of debt. Um, so this isn't that great of a stock. I wouldn't necessarily buy this one. Um, According to CFRA, they have a sell on the stock. They say the sell recommendation reflects shares being overvalued given significant fuel cost, volatility, exposure, creating earnings risks not adequately reflected in valuation. So their delta is at the total mercy of the price of oil. Even if the price of oil goes up, can they raise their prices on tickets to cover their costs? That's, I'm just surprised Warren would buy this. Okay, so while Delta Airline has a competitive advantage through premium travel exposure and capacity discipline, the largely unhedged fuel position leaves margins vulnerable for oil price fluctuations. The one interesting thing about Delta Airlines is they have their own refinery. So they have a little bit of an edge on the other airlines because they don't pay as much for oil. Okay, shares trade at a premium to historical averages despite challenging cost environment. Okay, they don't want to buy this one. They said stay away from it. Um, they say although they say to stay away from it, their fair value is double what it's trading at now. So they say it's undervalued by 54%. So I don't know what that means. But look at this earnings. You can see this negative 19%, zero earnings. It's the price of oil is running this company. It's the tail wagging the dog. So it's not consistent. I'm surprised. Hmm. It's not a stock I would like to invest in. According to Morningstar, it's 40% overvalued. So another hint that it's an unreliable company and it's overvalued right now. But you can see that it's gone up substantially since the beginning of the year. Um, all right. So, okay, here's another thing to look at. NVIDIA's stock portfolio is up more than 50%. And this year, look at these performances of the top holdings in their portfolio. Whenever there's like this pattern happening now where NVIDIA invests some of their cash flow in the companies that are buying their chip their chips. So we have a lot of these companies going up. So you know that during earnings, they have to say that they earned a substantial amount on their investments because it's called I think it's a mark to market. They have to say if they gain some gained some money in some of their investments, they have to realize it as income, which will really juice up their earnings report. Okay, let's look at the changes in Pershing Square. This is Bill Ackman. He he added to Amazon 19%. He basically sold out of Google. You can look at that. He sold out of all of his Google and put it into Microsoft, um, which is the opposite of what other people are doing. Warren Buffett is buying substantially Google and selling Amazon. So it's very strange for Bill Ackman, a follower of Warren Buffett, to do the opposite of what Warren Buffett's doing. So let's see who's goes up the most, Warren Buffett or Bill Ackman. Um, this is a portfolio of, let me see who this is. Hold on while I get this. It'll be worth it. David Tepper. Okay, this is David Tepper's portfolio. You can see that he added, he has a new position of SanDisk and rats. I totally messed that up. Hold on for a second. Okay, so so basically David Tepper sold some of his NVIDIA. He sold Meta by a large amount. He reduced al almost all of his, at least half of his Chinese holdings. I remember we went over he bought a lot of the Chinese companies like PDD Holdings, Baidu, Baba. He basically exited those and got into some of the, um, hold on for a second. He got into some of the AI winners. So I'm pulling this up in a different screen. I'll bring it over in a second. Okay, so let's look at this again. I'm sorry, I had the wrong screen up. Okay, this is Appaloosa hedge fund. You can see he basically established a new position in Amazon. 15% allocation. That is huge. And Micron is number two holdings. He added 11% to that. And he reduced a little bit of Google. And he had a new position in VST, Vistra. This is a AI infrastructure. They do energy, building out of energy um, for the AI data centers. And so we'll go over Vistra because it's one of his new positions. You can see he had a new position of Uber and SanDisk is a new position. So he has a lot of stocks that we're following actually. So let's look at Vista, VST, Vista Energy. I look at their earnings estimate. They're growing at 60%. No, they're 60. They're growing at 26%. Their PE ratio is 16. So their PEG ratio is, if you divide 16 by 26, you get 0.57. According to our little math there, it is 43% off. Their profit margin is great at 11. That's right what we're looking for. And their return on equity is 42. That's 3 times what we're looking for. And they don't have a whole lot of debt. They have 19, wait, actually, look, 19, they have 18 billion of debt out of 49. So they have some substantial debt, but whenever you're a utility, you have to borrow money to build out your energy plants. So that's part of the utilities. That's part of utilities. And they have a cash flow of a $500 million a year. So they're profitable. Um, let's look at what their chart is. Look at their chart is like sideways going back a year. And they're at the bottom end of their range and they're oversold. So this would be a good time to start looking at that stock. It's a utility. All the utilities are out of favor. We saw that from our chart of XLU. So whenever the stock market is going to go sideways to down and towards the summer, this could be the utilities, a sector to go to. Um, let's look at what Morningstar says. They said it is a price to fair value of 1.51. They think it's 50% overvalued. Wow. Okay, let's look at what CFRA says. They say it's a buy. We maintain our 4 stars recommendation. Nuclear and natural gas producers are well positioned for increasing power demands from AI data centers, manufacturing, and EVs. Vistra's transformation with long-term deals significantly de-risks earnings and reduces commodity volatility. Major acquisitions and organic projects position Vistra for substantial capacity expansion. Okay, and according to CFRA, their fair value is 134. That means they're overvalued by 3%. So they're right around their fair value according to CFRA. Okay. Okay. So I thought that was an interesting session. I hope you enjoyed it, and I hope you have a great investing week going forward. And I'll see you next time.